Okay, so thanks a lot to the organizers for putting this paper on the program. So what I do in the paper is propose a theory for a stylized fact referred to as core-periphery interdealer network. So I know not everyone in this room works in networks, so I'm going to take a step back and give you a super kind of big picture motivation for the paper. Okay, so we saw how the 2008 financial crisis raised serious policy questions regarding financial intermediaries. Some of these questions were: is the financial intermediary industry too concentrated? Are some of them too big to fail? Is the network of intermediaries resilient to collapse of one of these banks? What's the optimal network in mitigating contagion, and so on? So today, I will not be answering these questions for you, but these are the sorts of questions I have in the back of my head that I want to be able to say something about kind of down the road. Okay? And one kind of important tool that will get us closer to answering these sorts of questions is a good model, in particular, a realistic enough model that can organize some basic stylized facts for us. Okay, so what I will do today is show you a model that I think does a really nice job of rationalizing broad set of stylized facts in the context of intermediaries' role as broker-dealers in over-the-counter financial markets. Okay, so here are the stylized facts. In the interest of time, I'm just going to focus on 3 of them. Okay, so first, if we look at how broker-dealers trade with each other on the interdealer market, we see what's called a core-periphery interdealer network. So this is an example of a core-periphery structure in asset-backed securities market from Burton and Chester's paper. So each node here is a broker-dealer. Links between nodes represent transaction history between broker-dealers. Both the size and the placement of the node on the graph represent the number of counterparties the dealer has had, as well as the fraction of the total interdealer volume they account for. Okay, so what this plot shows is you have, depending on the market, 10 to 30 large broker-dealers have the greatest number of links with other dealers, account for a majority of the interdealer volume, and as a result form the core of the network. Okay, and then you have hundreds, depending on some markets, thousands of other dealers who instead have very few links with other dealers, account for a very small fraction of the interdealer volume, and as a result form the periphery of the network. Okay? So you see this structure essentially in every over-the-counter market that we have data for. So this is going to be the main fact I want to be able to capture with my model. Second, this network structure you just saw is not a one-time random observation, but is highly persistent over time. So, for example, in muni bond market, if a dealer was a core dealer 1 month, the probability that they're still core dealer next month is 93%, and it's similar for peripheral dealers. Okay? In other words, dealers' intermediation roles are highly persistent. Third, this core-periphery structure is a statement about what's happening amongst dealers. It doesn't say anything about what's happening on the client-to-dealer segment of the market. So on the client-to-dealer segment of the market, again, in the muni bond market, top 5% of dealers by centrality, they account for 75% or majority of the entire client volume. Okay? So these facts have been challenged to existing models in the following sense. Recently, there have been a lot of papers, a lot of interest in explaining this core-periphery structure, and models written down saying they generate core-periphery structure. But if you look at these models closely, they all assume some kind of ex-ante heterogeneity among the agents. Okay, so for example, in Nucleodov, some agents are endowed with superior trading technology and as a result resemble a core agent. In Atkinson-Eisfeld-Weil, some banks are born with a larger number of traders and hence look like a core bank and so on. Okay? In terms of persistence, all kind of current state-of-the-art network models are static and hence cannot say anything about persistence. The only dynamic models with network implications are search models, but standard search models imply that networks are random. Okay? And the ones that do generate persistence rely on ex-ante heterogeneity. And often these models, they lack meaningful distinction between clients and dealers, or they cannot capture simultaneously a bunch of facts on the dealer-to-dealer segment at the same time, a bunch of facts on the client-to-dealer segment of the market. Okay, so there's this gap between data and the model. So what I'm going to do, given this gap, I'm going to raise the following question, which is, how do we generate dealer heterogeneity as an equilibrium outcome? Okay. why are dealers heterogeneous in the first place? Why do core and peripheral dealers coexist? Okay? And whatever the mechanism is that generates this heterogeneity, it needs to be able to, at the same time, be consistent with all these facts about core-periphery, network persistence, and the heterogeneity on the client-to-dealer segment of the market. Okay? So to tackle this question, I'm going to build in this paper what looks like a directed search model of endogenous network formation between dealers. Dealers in the model are exactly identical, but the customers are heterogeneous in their liquidity need. Some customers just want to buy and hold an asset. Others buy knowing that they'll turn around and sell quickly. Okay? So I show that dealer heterogeneity arises from specialization. Different dealers specialize in different clients with different liquidity needs. Okay? So in this heterogeneity in the composition of clients ends up generating heterogeneity in the volume of client orders the dealers receive, where the dealers that, let's say, specialize in more high liquidity investors, they receive large volume of client orders. The dealers end up specializing, let's say in more buy and hold investors, they receive small volume of client orders. Okay, so how does this explain core-periphery structure? It's very straightforward, where the dealer that ends up receiving large volume of client orders, they end up trading the most with other dealers, and as a result form the core of the network, and vice versa for peripheral dealers. The reason they're peripheral is because they end up receiving small volume of client orders. Okay? So the main message of the paper is, if we just look at how clients form around dealers, that goes a long way in rationalizing what's happening between dealers. Okay? In other words, these patterns between dealers is really driven by client traits or client needs. Okay? And this insight is going to be the main contribution of the paper. Okay, so let me jump to the model. It's a continuous time infinite horizon environment. There's one asset, a bond with fixed supply S, and two sets of agents and customers, and n exactly identical dealers that I'll index 1, 2 through small n, and denote their set with capital N. So I'm going to take 2 slides explaining how customers are set up, and then 1 slide on dealers. Okay, so customers, in a nutshell, they have a private high or low valuation for the bond. High types in equilibrium want to own the bond, low types don't, and these valuations change randomly over time, which generates a need to trade and rebalance their position. And they can only buy and sell through a dealer, and the assumption I make is once you purchase through a dealer, you can only sell back to the dealer that you originally purchased the bond. Okay, so I'm going to elaborate on this. Okay, so there's effectively OLG structure to clients where prepared there's flow of investors entering the economy and flow exiting. So I'm just gonna explain how clients is set up by walking through a life cycle of a typical customer in this model. Okay, so customers, they're born as a high type. In other words, they're born wanting to buy bonds. They pick one of the dealers optimally, let's say dealer I, becomes a buyer client of the dealer, which just means that they submit their buy order, and then waits for some time for the dealer to fill the order, and becomes an owner client of the same dealer. Okay, and so at some point, these investors get a valuation shock. So if this happens after they've purchased the bond, they'll find it optimal to sell the bond. In other words, they submit their sell order with the dealer. Once the dealer fills the order, the investor exits the economy. If this happens after before they could purchase the bond, they'll just immediately exit. Okay? So at any point in time, it means that you have these masses of clients at different stages in their life cycle attached to the same dealer. Okay, and I'm going to denote with mu's masses of clients, and going forward, I want you to interpret the buyer and seller mass of dealers as the volume of client orders the dealer has outstanding that they haven't executed. Okay. Okay, so also I mentioned earlier that customers are heterogeneous in their liquidity need. So how I model that is each investor is born with a different K, where K is the intensity with which they revert from high to low. And the distribution over K has continued support from K lower bar to K upper bar. So take, for example, high K investor. these investors, they expect to get a valuation shock quickly, which means that after they purchase the bond, they expect to have to reverse the position and sell back quickly, okay? So I'm gonna call these investors relatively high liquidity investors, and then take, for example, an investor with a low K. These guys, once they purchase the asset, they expect to hold the position for a long time. So these are, I'm gonna call them relatively buy and hold investors. You can think of these as pension funds, these are more index funds, for example. Okay, so this is how clients are set up. Now let me take one slide explaining what dealers do. So their role is to intermediate for clients, and they're gonna do that in two ways. First, they take their, let's say dealer I, dealer I takes his buyer and seller mass and creates in-house matches at a rate equal to lambda D, which is some exogenous matching efficiency of a dealer, times the mass of sellers he has, times the mass of buyers he has. Okay, so in this, and the arrows indicate the direction that the bond is traveling. Okay, and then the second way dealers intermediate is by calling up other dealers. So I'm gonna define two dealers, I and J, as connected if they take their respective client masses and together create inter-house matches, now at a rate equal to lambda DD times, in this case, mass of sellers of dealer I times mass of buyers of dealer J, okay? And it's same thing for bonds traveling in the opposite direction. And the same applies to any kind of pair of connected dealers. So for example, if I had 3 dealers who are all connected, the entire network would look like this. Okay, and let me point out that this is economy in a snapshot, which just means if it were to freeze the economy to an instant, you would see at different parts of the economy, different pairs of dealers trading potentially very different volumes of trade, all in that same instant, and same between buyers and clients. Okay, so while on this slide, let me mention 3 things: who makes what decisions, what do I mean by endogenous network formation, and how do I measure network centrality of a dealer. So in terms of who makes what decisions, so if you remember, the main thing I want to make with this paper is to say, if we look at how clients form around dealers, that explains a lot about what's happening between dealers. So to really kind of drive this point home, I'm going to shut down any decision making by dealers and let customers do all the decision making in the model. Okay, so in particular, I'm going to assume complete network among dealers. They all connect to each other, but clients or customers, they optimally connect to a dealer, and when they do that, they internalize the entire network structure. So they're going to internalize where a dealer is in the network. Is it relatively core or peripheral? They're going to internalize the client composition and size of not just the dealers that he's considering, but also of all the other dealers he's connected to. Okay, and then what do I mean by endogenous network formation? So, you know, if anytime someone mentions endogenous network formation, there are 2 dimensions. The first dimension is, do I connect with Adriano or Andy? And then the second dimension is, once I'm connected to Andy, you know, do I trade, how much I trade with Andy? Okay, I don't know, I need to drink some water. Okay, so I'm going to address the second dimension, which is how I'm going to, again, I mentioned that I assume a complete network, that each dealer is connected to everyone else. But I tackle the second dimension, which is once we have a pair of connection between dealers, what's the volume of trade between those dealers? Okay, so in other words, endogenous, what's endogenous is network weights. Okay, so how do I measure network centrality of a dealer? I'm going to measure network centrality of a dealer by its interdealer volume. Okay, so for example, for dealer I, it's going to be the total interdealer volume of the dealer. And this measure of network centrality is the same measure as, because each dealer has the same number of connections with all the other dealers, as the other dealers, this measure is the same thing as number of connections each dealer has, weighted by the network strength. Okay. Okay, so I'm going to have two more slides on model environment. I'm going to characterize steady-state equilibrium. In particular, let me show you two sets of steady-state conditions. First, it's going to be a bunch of conditions that characterize client choices, and then I'm going to show you a bunch of steady-state conditions that characterize prices. Okay. All right. So the first set of steady-state conditions is going to pin down client choices. Clients make two sets of decisions. First, which dealer to be client of. So, and it's straightforward. Let's say Keita buyer chooses dealer I with probability equal to 1 if the continuation of doing so exceeds choosing any other dealer. Some interior probability if he is indifferent between two dealers and chooses some other dealer if that makes him better off. The second set of decisions agents make is in terms of their asset position. And as standard in the literature, what arises out of the asset position is a bunch of equations that characterize their continuation values. So let me walk through this really quick. So here's an example, how the continuation value of a buyer client evolves over time. So in a small time interval, t2 plus t plus dt, with probability k dt, the buyer gets a valuation shock and exits the economy with zero utility. With this probability, the buyer is matched with a seller who is a client of the same dealer. In that case, he turns into an owner, so his utility changes to that of an owner-client minus what he paid for the asset. This fraction is simply the fraction of the total buy orders the dealer fills through in-house matches. Okay, and it's same thing for inter-house matches when I'm instead matched with a seller who's a client of another dealer. And if I don't get a valuation shock or I'm not matched with any sellers, I'm still waiting for my buy order to be filled, then the investor remains a buyer. Okay, and it's analogous for owner clients. The only thing to note here is the continuation value of an owner client depends on how fast he expects to revert to a seller, and if he does, what's the expected utility of a seller client. And so here you start to see a little bit the trade-off buyers face in choosing across dealers. I'll come back and explain the trade-off, but for a particular parameter range, the trade-off in choosing across dealer ends up being between what kind of expected utility I expect if I become a seller client of this dealer versus how expensive the dealer is when I want to buy the bond from him. Okay. All right. And then the second set of equilibrium conditions I'll show you is how prices are set up in this environment. So prices I model as arising from a sharing rule in the following sense. So the total gains from trade, let's say in-house matches, is going to be the difference between end buyer and end seller's reservation value. And the prices are such that each client captures ZD fraction of the total gains from trade. And the remaining 1 minus 2 ZD goes to the dealer. So in this case, the dealer is buying from a seller client at the bid price, turning around and selling to the buyer at the ask price. Okay? And it's going to be analogous for two dealer chains, except I'm going to allow the fraction that the two end clients capture to be potentially different in two dealer chains as opposed to in one dealer chains. Okay? So what I've shown you is how clients are set up, how dealers are set up, and kind of two sets of equilibrium conditions. Now let me move on to results. Okay, so I show that there are two types of equilibrium, symmetric and asymmetric. Symmetric equilibrium is defined as an equilibrium in which dealers have identical client size. So in the symmetric equilibrium, dealers do not specialize. Each dealer serves the entire spectrum of customers from the most buy and hold to most high liquidity investors. Okay, and because each dealer has the same client mass, they also have the same network centrality. Okay, and so it just shows that even in equilibrium, despite customer heterogeneity, you may still end up with identical dealers. Okay, so asymmetric equilibrium is where all the interesting results are. So this is one of my two main results slide. Under some parameter condition that I'll explain in a second, an asymmetrical equilibrium exists in which dealers specialize. Okay, So dealer, let's say indexed 1, serves the set of most buy and hold investors. Dealer index 2 serves a bit more intermediate range of investors, and so on until dealer indexed N, who ends up specializing in the most high liquidity set of investors. Okay, and these buyers at in the cutoff are indifferent between the neighboring dealers, and how I've labeled these dealers doesn't matter. Okay, so important heterogeneity arises out of the specialization, and that is in terms of client sizes. Okay, in particular, the dealer that specializes in the most high liquidity investors, they end up with the largest buyer and seller client mass, whereas, and the opposite for the dealer that ends up specializing in the most buy and hold investors, they end up with the smallest client size. Okay? So the main takeaway from this slide is both the client composition and client size are heterogeneous across dealers. Okay? All right, so in the remaining slides, what I'll do is I'll show you how the interdealer network looks like in the asymmetric equilibrium, and then I'll come back to the other two stylized facts, and then I'll show you how buyers trade off across dealers. Okay, so this is how the interdealer network looks like in the asymmetric equilibrium. So each node here is a broker-dealer or a dealer, and before you were seeing the client circles, I've removed them so I can show you a greater number of dealers. Now the size of the node represents the client's size of a dealer. Okay, and links, the thickness of the lines between dealers represent the volume of trade between dealers. Okay, and the placement of the dealer represents the fraction of the interdealer volume they account for. All right, so what this graph shows is the dealer that ends up receiving the largest volume of client orders, they end up trading the most with other dealers, and as a result form the core of the network. Okay, and then it's vice versa for dealers who end up receiving small volume of client orders, they end up trading the least with other dealers, and as a result form the periphery of the network. Okay, and the intuition is very straightforward. If I'm a dealer who receives large volume of client orders, or I have large volume of client orders outstanding, I'm going to end up intermediating large volume of intermediation chains, both in-house and inter-house. Okay? Okay, so this was the main fact I wanted to be able to explain. So let me come back to the other two stylized facts. So the core-periphery is a steady-state property. In other words, when a dealer, it doesn't matter how small we make the interval, when a dealer is a core dealer, he remains a core dealer period to period. And same for peripheral dealers. So the model generates persistent intermediation rules. Okay? And I already mentioned this before, in equilibrium, essential dealer intermediates larger volumes of both in-house and inter-house chains. Right? And so I was denoting the volume of in-house chains with MCDC and equivalent for inter-house chains. So since at least one end of a client, end client of these chains is a client of a core dealer. So in this case, for example, both clients are clients of a core dealer. In this case, just one of them is a client of a core dealer. This straightforward implication of this result is that core dealers trade larger volumes of client trades. Okay? All right, so now let me explain how buyers sort across dealers. So for a particular parameter range that just simplifies intuition, buyers trade off the expected ask price of a dealer versus the liquidity service that the dealer offers. So what do I mean by liquidity service? It just means that the dealer either is buying back at a high price or offering higher execution speed, or both when I need to reverse my trade and sell my bond back to the dealer. Okay, and you can show that this liquidity bundle of a dealer can be captured by the expected utility of a seller. Okay, so here to show you this trade-off, I'm plotting the expected ask price of a dealer and expected utility that I attain as a seller client of this dealer as a function of a buyer's type for relatively peripheral versus relatively core versus relatively peripheral dealer. So what we see is if I go to core dealer, he's more expensive to buy from. But in return, he gets better utility, better liquidity if I need to reverse my position. Either the dealer is buying back at a high price or offering faster execution speed, or both, okay? And instead, if I go to a peripheral dealer, he's cheaper to buy from, but in return, when I need to reverse my position, I get worse liquidity service. So then the question is, which customer goes to which dealer? If I'm someone who's a high K investor, I care more about what happens to me as a seller. I have a high liquidity need. I expect to switch to being a seller. So they'll choose a relatively core dealer for the high liquidity they offer, but I'm willing to pay the higher price. If I'm someone who is a low K, imagine I'm never going to reverse my position. I don't care about the liquidity part, and I'm going to primarily choose the dealer based on price. Okay. All right. So in the remaining time, what I'll do is I'll go back to the primary condition that was necessary for the asymmetrical equilibrium to exist, explain that real quick, and then I'll be done. All right. So this primary condition, in short, it just says if we see two dealers trade, it has to ultimately benefit clients. Okay, so there are two ways. So I'll explain what they do in the model, and then I'll kind of give you some thoughts on how to think about these parameters. Okay, so there are two ways to satisfy this condition. Either lambda dd needs to be larger than lambda d, or zdd needs to be larger than zd, or both. Okay, so lambda dd larger than lambda d just means, as I try to visualize here, two dealer chains generate larger volume. That's kind of indicated by the thickness of the two dealer chains. Okay. ZDD larger than ZD. So Z's were the fractions that clients capture, the fraction of trading surplus that clients capture. So if ZDD larger than ZD, it means that the two end clients each capture a larger fraction of the gains from trade in two dealer chains as opposed to one dealer chains, okay? And these conditions just capture in a very reduced form way any kind of mechanism that generates intermediation chains, okay? So for example, in How install, if dealers can share inventory risk by trading with each other, then they're willing to trade more with clients and as a result generate more volume of trade for clients. In Gloat and Up, if intermediation chains alleviate adverse selection and as a result generate more volume of trade. So both this inventory sharing and adverse selection stories, they will be consistent with lambda dd larger than lambda d. And then in this one, Athan and Wang, if a dealer wants to buy from a client, if they can turn around and sell to a bunch of dealers, then they're more willing to trade with the client, and in particular, they're willing to pay a higher price for the asset with the client. And so the takeaway from Viswanathan and Wang is intermediation chains result in larger surpluses to customers and better prices. Okay, so this will be consistent with ZDD larger than ZD. Okay, so I think, how much time do I have? All right, so let me conclude. So the main insight of the paper is to show that how clients from around dealers goes a long way in rationalizing what's happening between dealers. Dealers specialize in different clients with different liquidity needs, and that specialization in turn generates dealer heterogeneity and a core-periphery structure. I'll end by highlighting contributions of the paper to both network and search literatures. So the contribution to search literature lies in formalizing model with explicit both dealer-to-dealer and client-to-dealer relationships. And I think this is important because standard search models imply that everything is random. For example, if I trade with somebody and never trade with that person again, but we're starting to see a lot of evidence that that's not the case. Often both clients and dealers themselves, they trade with only a few other agents. Okay? And the contribution to the network literature lies in, I believe this is one of the first papers that features endogenous network fates. Okay, thanks a lot.